and welcome to another edition of Targets in Focus, where we ask a trader or professional to take a look at three currency pairs and give us their short, mid and long-term predictions. Today I'm speaking to Neal Gilbert, market strategist at GFT Markets. Neal, thank you for joining us today. Now, the controversial bailout deal for Cyprus has been weighing on currencies this week, keeping the euro pinned near a 4-month low against the US dollar. What do you think we can expect to see from this currency pair?
Certainly, Jennifer, I'd be happy to. First of all, the Cypriot situation that's going on right now is definitely creating a lot of pressure on the euro, specifically against the dollar and against the yen and against a variety of other different currencies as well. But specifically looking at the euro versus the US dollar, we did see a gigantic gap early this week from where we closed at last week and where we opened up this week. And since then, the markets have just essentially gone sideways with not knowing exactly what Cyprus is going to do with this whole situation. So the whole idea behind a tax on depositors, though, in my opinion, is setting a very dangerous precedent for the European Union. You can see that the nations within the EU that are getting a little bit sick of providing all these bailouts for these struggling nations are starting to demand more and more. And I think as we move forward with this type of scenario, as more countries come to the strong or the core of the European Union and say, hey, we need a little help here, they're going to continue to go down this road, I think, as far as demanding further things other than just austerity, because they can see that the austerity measures just aren't working in Greece, so they're looking towards other methods. And especially with elections just around the corner, especially in Germany, it's politically unpopular just to give money over to these struggling nations without demanding more. So in that case, I can see a lot of weakness continuing in the euro. Specifically over probably within 1 month here, we're probably going to see just a little bit more weakness down around 128. And depending on where we see with these with the parliament in Cyprus, what they decide to do with this whole situation, whether they decide to let it go through or look for different options, I think there's going to be pressure on the euro. Continuing with that, in about 3 months, I expect the euro to be down around 124. Now, there's other issues that are associated with that as well. We do have Italy, which is looking at their election, still kind of up in the air. Kind of everybody's forgotten about Italy and their election since the Cyprus deal has gone down. So that is still something that is a risk to the market, a risk to the euro, and I think that more than likely we're going to see the euro continue to fall over the next few months. In addition to that, we do have the Federal Reserve here in the United States, which could potentially be looking at bringing back their quantitative easing program. Since we have seen the QE program go through, especially with QE3, this most recent one, there has been talk about scaling it down. And in that process, they more than likely will continue to increase the strength of the dollar, especially with the U.S. economy starting to get back on its heels or get back on its feet again. We're starting to see the dollar come back quite a bit against virtually everything. So in that case, in the 12-month reaction here in the euro versus the dollar, I see a continued fall down to around 115 during that time frame.
The dollar-yen has been back and forth this week on the Cyprus news. We had upbeat data on US building permits, adding to the view that the country's economic recovery is gaining traction. And we also had the changing of the governor of the Bank of Japan. How much has this news affected the dollar-yen?
The dollar-yen is a very unique kind of an animal here, because what we're seeing is kind of the combined forces between the United States and Japan in devaluing the yen. You have the strength in the U.S. economy, and like you had mentioned, the building permits and a variety of other different types of economic indicators. The United States appears to be coming right back on, especially with non-farm payrolls that we have seen above 200K very recently here. So the government or the Bank of Japan over in Japan is also actively trying to weaken the yen. The whole policy of Abenomics, and now that Shinzo Abe, the Prime Minister of Japan, has his, I guess you could call them inside men over at the Bank of Japan, we're probably going to continue to see Japanese weakness. So over the 1 month span here, I do see the dollar versus the yen continuing to climb higher. Now, it won't be too extreme. I kind of see this as kind of a pausing phase here in the dollar yen after the extreme run-up that we've seen recently. So I expect in 1 month we'll probably still be around the same area that we're at now, somewhere around 96. but I think that we're probably going to continue to accelerate that as we move forward later on this year in 2013. So the 3-month target that I have here for the dollar-yen is around 98. And then finally, for the longer-term situation, as far as our 12-month type of outlook here, I expect something much higher, well above the 100 level. I'm looking at around 110, and a lot of that comes down to the potential for something kind of going wrong with this whole idea of weakening the yen in order to be able to try to bring reflation back to the Japanese economy. We could run into some kind of a hyperinflation type of a situation, which is obviously a very bad thing. So they'll try to do anything and everything that they can in order to try to prevent that from happening. But so does every other country that doesn't want hyperinflation in their nation. It just happens sometimes. And I think that could be a risk to all of this Japanese easing that we've been seeing. So the 110 target that I see for 12 months from now is perhaps a little conservative even, and it could be much further beyond that if hyperinflation does take hold in that economy.
We had higher CPI figures in the British economy during February. Would you say there is a theme of pound debasement on the market's minds at the moment? And what do you see for the pound dollar?
The Great British Pound is very fascinating recently because since the beginning of 2013, the Great British Pound has actually been the worst performing currency that we've seen across the board when it comes to the major G10 economies. Now, most people would consider that to be the Japanese yen because they are actively trying to weaken it, but in actuality, it's been the Great British Pound. And a lot of this comes down to fear of a triple-dip recession going on in the UK. Not only that, but we have a new Bank of England head, Mark Carney, coming in the middle of 2013. And the general thought process is that he is going to provide even more quantitative easing to the UK, start to go down a lot more of an easy path than Mervyn King has during his time as the head of the BOE. So that kind of process has really weakened the Great British Pound in the near term. However, I believe that a lot of the things that we've been seeing going on in the European Union are going to start to weigh on the thoughts of European investors. And European investors, whether it be bond holders, whether it be just regular old Joes who have money in deposit at a savings account, are going to be looking for alternatives. Now, Switzerland isn't necessarily the greatest option for many of these types of investors, so I think that we might actually see a little spillover into the Great British Pound. And with the weakness that we've seen so far in 2013, I think that a big jump back up in the Great British Pound could be something that we do see despite some of those inflationary things that you had mentioned. Now, over the next 1 month, I actually expect the Great British Pound to run up to about 154. And I expect that to continue over the next coming months. And in 3 months' time, I would not be surprised at all if we see the Great British Pound around 160 once again. So that's quite a bit of a strong move for the pound, but considering the extreme weakness that we've been seeing, it could come back quite strongly, kind of the whole rubber band type of ideology with that. Now, that being said, with Mark Carney, again, coming in and potentially providing even more quantitative easing, essentially trying to weaken down the pound with this whole currency war situation that we've been seeing around the world, I think that the Great British Pound could essentially lose value over the very long term. Just because we're looking at strength over the next 3 months doesn't necessarily mean that it's going to be strong forever. So in that concept, I do see the Great British Pound weakening back down to 150 in 12 months' time. And again, the U.S. economy could also kind of build on that as well, as far as the U.S. economy starting to come back full force, and other parts of the world, in the UK, in Europe, in Japan, and other places, struggling in order to be able to gain their footing.
Thank you to Neal Gilbert there for his excellent insights and predictions. There'll be another edition of Targets in Focus on Friday. Goodbye.